All right, so welcome to the official September 2022 housing report. Lots to talk about, Mr. Frost, and it's been a while, but welcome back to the show.
Thanks.
And we always appreciate.
I was back like last
You
month.
were back.
I just
You were
did a
back.
small hiatus during the summer.
Yeah, so
now we're rolling.
I love it. So we have Steve Frost from National Mortgage Funding with us this morning, and we have a lot to unpack. So let's jump into it. First thing I want to walk through is the Fed met last month. And oh boy, I mean, it's an absolute shitstorm with everything that's happening. And so I want to first unpack that meeting. There's a lot to talk about.
Yeah.
And then we're going to walk through mortgage interest rates and then get into the housing market so that people watching the show can get some good takeaways. All right.
Yep.
So first things first. So the Fed, their whole position is to raise interest rates in hopes to slow the economy, to ultimately bring down inflation, which is absolutely insane, the highest it's been in quite some time. So what are your thoughts on that?
I mean, that's the job. That's what they do, right? So the Fed really, all they do is manage. They manage inflation and economic growth in relativity to employment, right? So they want to keep as many people working, making as much money as they can, but at the same time, they don't want the prices people pay for things to get out of control. So, you know, we saw a lot of like quotes and different things coming out from leading up to all these massive spending packages that we did and lowering rates and what call it fiscal accommodation, right? So we saw so much leading up to this. And the Fed, they really got caught behind the eight ball. It's like everybody's screaming at them from the mountaintops. Like, if you keep stimulating and you keep doing this, like inflation is going to get way out of control. And here we are.
Yeah.
And
as far as printing the trillions of dollars, giving money away, all that is what you're talking about.
Exactly.
And people are warning them left and right, listen, you're going to put us into an absolute shitstorm if you keep just giving this money away and you keep printing money. And that is exactly what's happened.
And it's not the first time they've done it. You know, like if you look back historically, if you look back to like the 50s and 60s, 70s, like this happens all the time with them. Like they get behind on the eight ball inflation. They raise rates like crazy. Well, the thing that they're really like, if you read a lot of the data in the notes, they're talking about, you know, they have an employment goal, right? Where the unemployment rate's like 4.4% or something. That is literally like the last indicator of a recession, right?
Yeah.
So they're just going to like watch all the, you know, like what's the guy's name? The big gorilla guy in China? What's that? Like Hong Kong or King Kong? I don't know. So King Kong is going to go goof around in the city and then whole city will be gone. They're like, whoop, he's to the fancy bridge. Like we're at the end of this thing now.
Right.
Like inflation's over.
Funny.
Like there might be a recession back there. And like the whole thing's a disaster.
Yeah.
You know?
It's crazy. And so they raised rates 0.75 of a point, right? And we all believe, well, at least I'm under the belief, I don't know what your position is, that the Fed's going to meet 2 more times this year. And we're going to talk about what their plans are in a second.
Yeah.
So they raised 0.75 of a point to try to get inflation. The goal is to get inflation down to 2%. That's the goal. And so the interesting about the meeting that he talked about is how long is that going to take?
Yeah.
How long are we going to be in an economy with high inflation, slowing this market down, potentially in a brutal recession? We don't know how this is going to impact everything. And so let me play a clip from the meeting where he talks about how long this is going to take.
Yeah.
And then I want to get your thoughts on it. All right.
The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025.
So what he just said was that we are going to be potentially in a rising rate environment for the next 3 years. When you think about that and when you hear that, what do you think about? Where does your mind go?
Well, I mean, it depends on to get to that level of inflation. So I think that because what's going to happen is like we're comparing the thing that really has them unsettled is a comparison of year over year inflation, right? So like when they look back at a year ago, inflation is still growing right now. So like inflation is still going up and we've done a number of rate increases already, really aggressive ones. They've stopped all of their fiscal accommodation. And by that, I mean purchasing of mortgage-backed securities. They stopped purchasing treasuries and now they're letting them roll off their balance sheet. So it's a two-pronged approach. They're being really aggressive for it. Well, if you think about it, inflation really started to get bad like this time last year, right? So like last summer, we saw the year over year inflation numbers coming up like 0.1, 0.2%. And this year we saw it coming up 0.6, 0.4, those kind of things. So we're seeing inflation rising because we're replacing a 0.1, 0.2% growth over last year's numbers. Now, as we start rolling into, so it'll be the comparison of the CPI from November. The report will come out in November, but it'll be comparing it to October, where we'll probably see that grow like 0.1 to 0.2 compared to a 0.5 or 0.6 last year. So we're going to start seeing inflation. We're going to start seeing the year over year numbers come down. Right. So, and they'll continue to raise rates, but that doesn't mean, I don't think they mean that they're going to raise rates continuously until they reach 2%. What they're going to do is they'll raise them aggressively until they see it bite. Right. So you start, and then see a meaningful decrease in inflation, right? Or decrease in the growth of inflation. And so as we look forward, like the next 6 to 8 months, we're going to see them an inflation that's going to be impacted by these rate changes, which they really should start taking hold. And we'll really see, it'll be really interesting to see through the holidays and what kind of sales and things we have, because there's a lot of like retail inventory
in the midterms,
and things like that. Yeah, midterm
that's
elections
a huge
coming
thing.
up. And oil and gas. I mean, there's a number of debacles happening at one time, but when like you strip out fuel costs though, and you look at more of those types of things, like we should start to see by next year some of the inflation numbers coming down, which should slow the pace of those increases.
Yeah.
Or change around some of that.
I agree, but are you concerned that we now know that it's almost guaranteed that we will continue to raise rates in order to get that inflation down? And so the question I think a lot of people have, consumers, homeowners, real estate professionals, is what does that mean? And we're going to get into that a little bit later in the show, but does that mean that we're going to be in a recession for the next 2 years? Does that mean that we're going to, what does that look like from the economy standpoint?
Right. Economic, you will, and we probably already are in like technically speaking, when you look at like GDP reports and like there's a lot of, they call them like canary in the coal mine reports, where like unemployment claims and things like that are going up, which isn't as heavily reported as what came out today, which was the BLS employment numbers, which came in higher than they thought. The unemployment rate decreased, but and I've been busy this morning, but I haven't been able to get into the meat and potatoes of that. But I'm
the jobs report.
The jobs report. But I'm guessing based on the way the market responded to it, not that bad. And so I'm thinking a lot of that has to do with like part-time jobs.
Sure.
And so, but what I'm trying to get at though is that in our minds, the recession is 2008-9, right? Where there's like abandoned homes and like rusted out repoed cars and like banks with "we're closed" signs on the doors, and Kmart went out of business and things like that. So we have to understand that was like that was like a once in a million years recession, you know? So I don't think that the recession that we're looking at today is going to be the same thing. So I don't think from a perspective of, should I fear this recession? I don't think we're going to be in the same boat that we were. But the Fed has said it is going to be painful. Like retirement accounts are going to take a hit. I mean, you think in my world, like mortgage refinance applications are down 89% this year. Purchase transactions are down 38% this year. Like in housing, which you and I told people 3 years ago, we said in this pandemic and this recession, housing is going to lead us out of this charge. And I think ultimately as this recession presses on, again, they'll come back to it because it's so easy to jumpstart the economy with a little bit of fiscal accommodation in the mortgage world to start, get housing propped back up and start moving the economy again.
Yeah. You know what? You just said something that I totally agree with, as far as, people hear trigger words like, housing, the housing market is normalizing, or the housing market is going through a correction, or we're in a recession. And you're right. People's mind automatically go right back to 2008. And so later in the show, we're going to talk about and give people real context between what's happening right now in the housing market with mortgage interest rates. And then we're going to compare that to years past. So the audience can say, okay, wow, that's a really good point. When I give it some context, when I have something to compare to, it's actually not that bad. So to your point, Powell also talked about in the meeting, savings,
Yeah.
that people are in a good financial position. So he is under the belief, or the Fed is under the belief, that we can take it.
Yeah.
We have savings. To your point, you talked about this the other day with me on a phone call, that as the economy slows and as we get in deeper into this recession, that the American people can withstand some of that economic slowdown.
Yeah.
You agree with that?
I agree with that. I also, I mean, if you dig deeper on some debt figures, though, we're currently running at, consumers carrying the highest amount of revolving debt that they've ever carried.
Interesting.
So is that that might be a product of like, and I say this to clients all the time, because I'm always trying to speak on like Main Street, right?
Yeah.
And I'm like, think about how hard it is. And I talk about this with down payments and stuff, where I'm
Right.
like, 5% down or 20% down gets you the same rate on your loan. You just have to deal with PMI. And what does that look like?
Sure.
But I always say it's so hard, and I think a lot of Americans feel this way, a lot of people, is that it's so hard to get money in the bank.
Yeah.
Like, it is so hard to go work your job. The paycheck goes in there, you pay all your bills, and you're like, shit.
Yeah.
Like, what happened? You know, so I think a lot of people that have that savings right now, they would rather have the savings and a shitload of credit card debt than take all their money that they have in the bank and pay those credit cards, because they just don't know.
Yeah.
That uncertainty, and it's super hard to get money in the bank.
Yeah.
No,
that's a really good point. And he did, to be fair, he did talk about, there's some people that are living check to check with this inflation the way that it is killing them.
Yeah.
They don't have the savings that maybe some of the other people have to ride out a recession. And for some people, it's going to cause massive financial hardship over that. And that will be the thing that unveils itself.
Yeah,
that could
for
have
sure.
the greatest impact on the housing market. Because if we start seeing foreclosures left and right, because people are losing their jobs or they don't have enough savings, that's a whole nother topic. We haven't seen that yet, right? But that's something to consider too.
Well, and foreclosures being the lowest. How am I doing? Oh, thanks. Thanks, man. You're just
Now
taking
we're
care of me.
talking to each other, and now it's all good.
All right, good. So, I mean, foreclosure numbers are and we've talked about this before, like foreclosures as a function of a functional housing market, to, people make money on there's a whole foreclosure industry, right? That's been non-existent. It's totally been in the basement because we have so many tools to protect against foreclosures.
Sure.
And so I think and I know just from my own business in the mortgage world, I've got a load of investors that are like, I'm just waiting for foreclosure. So I think it's something to keep in mind for people that watch this. Like, foreclosures are not a bad thing. They are a normal function of the housing market, and they serve a really, really important piece of it. And it's been totally missing.
Right.
When you start looking at like driving up the prices of homes and what people are paying, right? Everybody's like, I can't believe these home prices. Well, yeah, there's no foreclosures.
Right.
Do you think nobody has to sell their house right now?
That's a great point. So let's talk about the when we talk about the Fed raising rates, we're talking about the Fed funds rate. So I want to talk about how that is impacting mortgage interest rates, because most of the people that watch our show are either consumers buying or selling homes or real estate professionals, right?
Yeah.
And so I want to talk about specifically, mortgage rates went into the 7% range. We haven't seen rates like that in a long time. So I want your take on how things are, these decisions that the Fed are making are impacting rates. And then I want to unpack mortgage interest rates based on your experience, what happens to rates in a recession.
Got it. Okay. So I'm going to give you I feel like I'm beating a dead horse, but now I'm good at it because I've explained it a million times. So, mortgage rates go up when the Fed raises their rates, and the Fed, to be clear, does not set mortgage. There's no set mortgage rates. Like, mortgage rates are determined by a bond market, right? So why do they? Yeah, but they're like, okay, well, Steve, Fed's raising rates and mortgage rates are going up. It seems like pretty obvious. So here's how it goes. Both mortgage rates and the Fed funds rate are both 100% driven by inflation. So what the Fed funds rate does is the Fed has it's money that banks have. So a bank is required to have a certain amount of assets on hand to cover the money that they're lending. So if a bank has more assets than they need to cover their balances, they can take that money and they can lend it overnight. They lend it to giant companies, maybe overnight, maybe it's a week, 2 weeks. They lend it to giant companies to make payroll, or they might use it for research and development, or like different product offerings and innovation and things like that. So what happens is, when inflation is high, when the prices of things are going up, the Fed raises that cost for companies to borrow money short term. And what that does is it essentially slows down hiring, slows down product innovation, it slows down sales.
That's exactly
As
right.
these companies are slowing down their sales, their stock prices tend to come down. People can invest their money in these things and they charge less for their product if there's not as much demand for them. On the mortgage side of it so the Fed's raising rates to do that, right? So they're fighting inflation with this tool that they have.
And just for the audience standpoint, I think this is really important, is that they understand that the Fed is the United States central bank.
Yes.
Yeah. And the Fed funds rate is the rate in which other banks borrow money from the Fed to your point, lend it out to maybe other institutions or direct to the consumer, and then they charge a premium. Sorry, go ahead.
That's all right. So mortgages, on the other hand, the reason mortgage rates are going up when inflation is high is because mortgages are traded in a secondary market, so mortgage-backed security.
That's right.
And that's like a bond.
And we're going to talk about that too, for sure.
So the way it works is like big, like sovereign funds, pension funds, foreign countries, which I can get into in a minute too, which is interesting with what currency is doing. But they'll take these mortgage-backed securities, and these big funds will invest in these as part of an overall investment portfolio for billions of dollars, right?
Sure.
And a part of their money will be parked in a mortgage-backed security that provides a low rate, very safe place for your money. So instead of your pension fund having cash earning nothing, they'll put it in a mortgage-backed security or a 10-year treasury earning a very small amount. Well, what happens is during a time of high inflation, and as inflation's rising and prices of stock is going up and things like that, people would rather invest in the stock market where they're going to see, or invest in assets where they're going to see appreciation as inflation grows and the prices for things go up. They'll invest there rather than a mortgage-backed security, because if you invest, your $1 million in mortgage-backed securities in January, and those investments are going up or providing a rate of return at 3% or 3.25%, and inflation's going up 9%, well, at the end of the year, you've lost 6% of your money, right? So what the mortgage-backed security market does is say, okay, we still need this liquidity. Like, we need to have a function as a mortgage. That's how in order to write more mortgages, they sell these mortgage-backed securities. They take that cash and they write more mortgages and they back more of them. So what they do is they increase the yields on these things, right? So maybe you're paying back 5, 6, 7% in order to get people to invest their money in them. So what happens is mortgage rates go up because they have to they're the fuel, right? They're the fertilizer to grow these bigger returns.
Yeah.
So what'll happen though, eventually the yields on mortgage-backed securities will get high enough where it becomes a good investment, where people are like, oh, this is a good place. I can make 7%. We're on the brink of a big recession, which we know what that does to a stock. And we're already seeing the stock market this year, right? So as these become a better investment in a recession, which this is leading into what we'll get into later, but there's a larger demand for mortgage-backed securities. So what do you do when there's a larger demand? You can pull back the yields that you pay on these things. You don't have to pay out as much when more people want them, and we start to see mortgage interest rates come down in a recession.
So that it was a great transition, and I really want you. Well, you just did, but
sorry.
No, it's great. It's great.
I got going.
It's exactly what I wanted to talk about. So I wanted the viewer to understand that even though mortgage interest rates are going up like crazy, which has slowed down the demand in the housing market, that the further we get into a recession, it actually, the opposite tends to happen, that mortgage interest rates start to go down based on everything you just talked about. Now, the question is, for the viewer, they say, okay, wow, that maybe gives us something to potentially look forward to if you're in the real estate space, or you're looking to purchase a home, or you're looking to sell and buy a home. What needs to happen for that to occur?
Yep.
And then when do you see something like that happening?
So going back to, and I get a lot of my economic data and guidance from the MBS Highway, which is Barry Habib.
Absolutely,
and
great guy.
He does every year. He does a thing where he shows like, here's what I forecasted and here's what happened, and then he's like, here's my forecast. Sure. So he does like a whole here's what I'm going to tell you. Here's how right I am all the time. Then here's what's going to happen. So they're seeing that, again, as I said, we're going to start replacing higher inflation numbers for year-over-year figures next month, which is in November. So we'll start to see a meaningful reduction or a meaningful change in inflation to the better going forward from there. So I think that in my opinion, and again, going back to mortgage-backed securities being pretty appealing with their yields right now, and with the rest of the globe seeing what's starting to happen, I think that in the next 6 months, we'll probably start to see interest rates come back down. Who knows? Who knows exactly? I mean, Fannie Mae's been out and said in 2023 we could see 30-year rates at 4.5%, which is a 2% decrease now, and
which makes sense.
Just that's $300 a month on a $200,000 loan. It's a big difference. So
massive.
But you never know. That's what's weird about these things, because we have other factors, right? There's a war in Russia right now, and energy costs. I mean, if you think, I was thinking about this the other day when I was in like 2008 or 9. I bought a GMC Envoy, and I bought a used car. I'm like, man, this thing's empty. Like they don't fill up used cars.
Yeah.
So I went to the gas station. I filled it up. I'm like, oh my God, my gas was $69 to fill up my gas tank. I was freaking out. I'm like, I'm not driving this. I gotta get a Honda. I'm going right back. And you think about it now, gas is higher than that now.
Right.
And like we're just paying it. You know what I mean? So it's going to be kind of an interesting thing, but it does smell a lot like the last recession. Like, here comes energy prices going up, and like all of these things are,
Well, the important thing, and we're going to start to transition now away from the Fed and their meeting, and we're going to start to get into more of the housing market. It's just simply a supply and demand, right? We talk about it on every show. It is so simple, yet it's so hard for people to understand, because the media loves to put out very, very worrisome clickbait titles that
100%.
freak out the consumer.
Yeah.
And the thing is, mortgage rates, as they skyrocketed as a result of inflation, it has slowed down the market. Home sales are down 20%. We're going to talk about that. You're seeing mortgage applications go down like crazy. And so the interesting thing will be, what will happen if interest rates go back down, because inventory levels are still really low. We still have a very strong housing market. We're going to get into all the details in a second. If we start to see interest rates go back down, do we just pick up right back from where we left off? Even if they settle in at 4.5%, it's a great market.
It's crazy.
Thoughts?
Still very super low. Yeah, I mean, and so I don't have I work in the mortgage space, right? Like I'm actively pre-approving people and closing loans and writing loans. So I look at a lot of just like the main, I call it Main Street. Like I'm down in there with the people, and there's a lot of buyer. I mean, the home buyer today is so savvy within like the last 3 years, because the media is so in your face with data. And I tell them all, I'm like, you understand that the headline that you're reading is literally to get you to buy the UGG boots in the ad alongside the meat of the article.
That is exactly right.
But that's one other thing. But I mean, I have a lot of my pre-approved buyers that are like doing two things, right? So I have pre-approved buyers that are like, I'm going to buy now and I'll refinance. So a lot of them are, I've never done a 2-1 buy down thing, which is like a whole mortgage program deal, but I've never done one of those before. I've done like 3 or 4 of them recently.
Interesting. Wow.
And I've got a lot of people are saying, I'm just waiting for rates to come back down, and then I'm going to buy something. Like, I'm saving more money, and I'm going to be ready when the market, when rates come down into a range where I want to be. And I'm trying to tell them, like, this might be, if you're counting on stopping renting, like if you're going to leave the renting world and get into a home buying world, and you're going to wait for rates to go down, I'm like, this, because it's either the purchase price or the rate, right? What do you call it? Chicken or the egg or something?
Chicken or the egg.
Like if your plan is to not move now, you're going to move in a year because rates will be lower. I told him, I said, the only thing that we know right now is what a house costs right now and what the rate is today.
Yeah.
So we don't know what housing prices are going to be in a year, and we don't know what rates are going to be in a year. But I can tell you, if rates are really high in the next year and housing prices stay high, guess what else is going up? The rent.
Yeah. Oh, absolutely.
The rent's going to continue to go up.
Absolutely.
So
well, and so I guess let's talk about that. So still, they're based on people trying to hypothesize, hey, what is going to happen with the housing market? Is it going to crash? What is going to happen to mortgage rates? Well, here's the thing. Powell, who runs the Fed, came out in the meeting, okay, and a reporter literally asked him, are you going to crash the housing market? Right? By selling off mortgage-backed securities. So take a listen to this, and then we'll talk about this.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side?
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now and not something I expect to be considering in the near term. It's just, it's something I think we will turn to, but the time for turning to it has not come and is not close.
So what's so interesting about that, it's like, I don't know what else the media needs to hear, that the housing market simply is not crashing.
Yeah.
What it is doing, and he said this earlier in the meeting too, and we'll play that maybe in a different show, is he believes that it needs to go through a correction.
Yeah.
It needs to normalize, and that is what I've been talking about for months and months and months since we've been going through this high inflation, is that the housing market is simply normalizing, Steve, to a pre-pandemic level.
Yeah.
And it's what it needs to do.
Right.
Jerome Powell also talked about, he also believes that home prices will remain high for quite some time.
Yeah.
That's what he said. And so, it's just interesting to your point earlier about how the media is just selling the click
Right.
for the advertising, but the consumer freaks out and says, well, should I not do anything? What should I do? Now let's get into the housing market. All right.
So one quick
ahead.
thing too
Please,
on that,
please,
just so people know what he's referring to with balance sheet runoff and selling mortgage-backed securities. So when I talked about fiscal accommodation, so where I said there's the mortgage-backed securities that the pension funds and all these things buy and they invest in mortgage-backed securities. Well, during the pandemic, and one of the things that the Federal Reserve will do to bring interest rates down, which puts more money in a consumer pocket, is the Fed will go out and buy like billions of dollars in mortgage-backed securities every month, and it provides liquidity for that market. So as I said, you don't have to provide much of a rate of return at all when you have a guaranteed buyer, regardless of the price. And so what's happening is the Fed has trillions of dollars of mortgage-backed securities that they own.
Yep.
And what they're doing right now as part of their fiscal tightening is what happens, those every year or whatever term it is, those roll over. So like, okay, this mortgage-backed security rolled over, you made your 3% or 2.5% or whatever on this bond. And normally what the Fed was doing was saying, okay, we'll take that 2.5% and the principal and we'll just reinvest it back into the mortgage-backed security market. And so what they're doing as part of this fiscal tightening right now is you just mentioned it, like the balance sheet runoff. So what they're doing is they're letting them run off. So when these mortgage-backed securities are maturing, they're just letting them fall off. They're not reinvesting the gains and they're not reinvesting the principal. They're just letting it roll off, which is getting back to a normal market. This is where this would normally trade with these pension funds and things like that. What that reporter is asking, are you going to sell mortgage-backed securities, which would be a bad thing. That would really, really interrupt interest rates and really send them to the moon, because now there's going to be a flood of these mortgage-backed securities in this market that are now for sale for somebody that's going to profit or even sell them at a net zero, right?
Yeah.
And so that's what they're talking about in that. He's saying, no, we're not doing that. Like, he realizes that would be disastrous.
Exactly. And that's what the reporter was essentially asking and suggesting, that if he or the Fed were to make that decision, that it would crash the housing market. And he blatantly said no.
I'm aware of the market, and no,
and
I'm not.
We're not even close to that.
Yeah.
We're not even considering that as an option at this point.
Right.
So for all the housing market crash YouTubers out there, hopefully you just go and hear it from the Fed that it no longer becomes a debate on, is the housing market going to crash?
Right.
Like, we've got to get off of that. You and I have been saying this for 2 years since we started the show.
Well, nobody wants to read about the housing market's going to normalize.
Like, you're right.
If I saw it, I'll be like, oh, okay, great, cool. Keep it moving. What's Kanye doing?
So let's talk. Yeah, exactly. He's been in the news a lot. So let's talk about the housing correction or the housing market normalizing.
Yeah.
I want to give the audience context.
Yeah.
All right. So number one, home sales, they are down 20%. This is simply a result, from my position, on mortgage interest rates rising, slowing down the demand of buyers.
You're referring to transactions, right? The number of sales is going down.
Month over month, just down 20%.
Yeah.
You tell us about mortgage applications, because you control, you being the mortgage guy controlling the demand, me, the real estate guy, controlling the supply. So it's kind of a cool thing. I just thought of that just now, by the way. So walk us through the demand from your point of view and applications and how much it's slowed down? Give us some context.
Well, it's we're dealing with a really well-informed consumer.
Yeah.
Right. Which is fine, which is great. Like that, it actually makes our job easier. The hard part is that when you're well-educated and inexperienced, sometimes is you end up in an analysis thing where you're kind of like, and just to put it in an example. So I had a closing today who yesterday called, and their agent called me and like, I think we're going to back out. She's like, my client's freaking out because they're seeing more and more homes that they like more than the one they're under contract to buy coming on the market for less money. So there's a lot of that, that I'm seeing right now where people are just like, I'm going to wait. Like people are being patient right now and they understand. And I don't know if it's because we've seen enough economic cycles or because so many people have refinanced in the last 24 to 36 months that they're like, interest rates are going to go down and we'll just wait then to buy a home. So it's just a holding pattern.
So let me interject there for a second. The waiting, I have never been an advocate of trying to time the market, which you and I've talked about. However, I do want your position on this now, because based on the data, not my opinion or the emotion, one could argue that waiting is better. Because of what we just talked about a minute ago. You don't have to agree with that. I want to unpack this from your perspective, that interest rates right now are roughly what on a 30-year?
6 3/4.
Okay. So, and you saw upwards of 7% a couple weeks ago, right? Yeah. So if I'm a buyer and I'm saying, okay, I'm going to wait because interest rates are going to come down, what is your level of certainty that they will, based on historical data, given that when we get deeper into recession, mortgage rates do, in fact, come down?
Yeah.
And so your position on people that wanting to wait, what are your thoughts on that?
Well, I'm in the business of getting people in homes.
Well, of course. Yeah,
so I'm like, let's go.
No, I get it.
No, but I
objectively speaking, without bias.
Yeah, I mean, so again, and I alluded to this before, you can't predict anything. Like I can't come out and say rates will go down. I do believe they will.
It's not will or will not. It's likely or unlikely.
Yeah. So it is highly likely rates will come down. And my opinion on it though is that based on my business, that's what I look at, right? Like you can have all the data in the world, right? But looking at my business, I have people waiting. There's a group of people that are waiting to buy houses for when rates go down. And I tell them that's great. Like, because the most important thing is you make your own choice. Like it's up to you when you buy a house. But if you're waiting, like when rates are high and demand is coming down, you are going to pay a better price. If you're waiting to buy a home based on the interest rate and you can afford that home today and you think interest rates are going to go down, we can refinance you. And it is not a big deal. Like refinancing is easy to do. And even in a market where you're seeing home prices come down, I mean, I think we saw in July, we saw them come down like 1.05%. And then home prices in August came down, or September, or whatever it was, came down 0.98%.
Prices are actually up as of last month.
From last year, year over year. So overall, year over year, but they've come down some this year.
Yes.
But it's like, there's still a massive, and again, we go back to looking at like where buyers are coming from and like birth rates, like going deep into the data.
Yeah.
And so I'm of the position, like if I'm renting or if I'm in a house, like if I want to move, like whether it's a need or a want, right? It's something that like, cause nobody really has to move. Like I have seen, I mean, I had a rental. It was 900 square feet with 3 kids and 4 Rhodesian Ridgebacks in there, So like people can live, like you don't have to move, right? You can make anything work. But if it is in your mind that you are going to move, my advice to people is move now. Like you are going to get a better price today, I believe, than you are going to get in 6 months when prices go down.
All right. So let me give you, and this isn't necessarily my position. I'm going to argue that point from a different point of view. So with the housing market or prices specifically, when we talk about prices normalizing, when we talk about the market correcting itself, that suggests that home prices are going to go down. You agree with that?
Yes.
Okay. To which amount is the next question you have to unpack. So let's talk about that. What has occurred over the past 20 months as a result of the pandemic and the lowest inventory in combination with the lowest interest rates have drove home prices up in some markets 25, 30%.
Right.
The correction suggests, just to your point, that they will go down. Some say 10%, some say 15%. So the average price of $407,000 right now, some would argue that in a year from now, that same home will be $370,000.
Yeah.
And those same people would argue, Steve, that instead of an interest rate being of 7%, that it might be 4.5%. Instead of house being $400,000, it's $370,000. Why wouldn't I wait for that?
Because you don't know. You know, if I want, and that's just my perspective is if I want to move, you want to make a move. But the median home price of a home in America today is $440,000 per the St. Louis Federal Reserve.
Yeah.
And last year it was like $424,000, right? So the big increase took place from 2019 to 2020, right?
Yeah.
It went from $260,000 was the U.S. median home price in 2019.
But we know why that happened.
Right. So there's that massive demand. The problem, my thing that I keep seeing though is that there's not, like, construction never caught up, because that's the new construction never caught up. Like the ranch condos that we've talked about never got built. Like there's still a big amount of demand for housing, and it can turn fast. When rates go down, there's just a large pool of buyers ready to purchase those homes. And I think there's a higher likelihood, in my opinion, or a higher predictability of interest rates coming down at a greater clip than home values coming down.
So, to be clear on this little mini debate, which is fun, is there is no such thing as an absolute in statistics.
Right, for sure.
It's just what is more or less likely to occur.
Yeah, exactly.
What I believe is more likely to occur, because we've seen, before I give you that, are you suggesting that home prices have more room to breathe, that you believe that home prices will will go up from here?
So, I mean, all the data shows that we're going to see much more moderate overall home value appreciation.
Do you think there's a retraction at all? Do you think that prices right now that are leveling off?
Yeah.
You're right, but the question is not the leveling off. The question is, okay, the average $440,000 home, or my data is from Redfin. They all have different information. $407,000, whatever the average price is.
Right.
The question first for us to unpack in the debate is, do you believe it's more likely that home prices will in fact correct, which suggests down, or stay the same?
So I do think they will correct down, but I don't think the correction will be that much. And I tell you, and I say that again, just seeing, I always look at what I see, right?
Me too.
And so, I mean, I'm still having like properties, like nice houses that you're like, wow, that's a lot of money for that. And these houses are still getting multiple offers.
Yeah.
Like I'm getting like multiple over ask cash offers in bigger numbers for the houses that are ready to go, And so,
but at the same point, price reductions are the highest they've ever been in years.
Yes. Yeah. 100%.
And more homes are expiring, not selling at all.
Yes.
So it's the chicken
in
and the
higher
egg.
ranges,
in
those higher price ranges. And you look at, if you really dig into the data and look at what's driving these home price decreases, if you look at those markets, it's your last month, the biggest decrease came in San Jose, California.
Yeah.
Second was San Francisco, California. Third was Seattle. And then you have Miami, who's still going up in that high end price range. You know, so it's hard to find what that middle ground. It'll be interesting to see what happens to that average U.S. median home price. But I mean, a lot of the transactions I'm doing are still above that. And maybe that's just my clientele, outside of like investors that I'm working with. But I do see a correction coming. Like there will for sure, home prices, they're going to come down some, but I don't think it's what everybody's looking for. I don't think it's going to be that massive drop.
Well, all right. So that's what I want to talk about next. All right. So thanks for your political answer.
Yeah.
You still didn't give us an answer, Mr. Politician.
Yeah.
I'm just kidding. So watch this. This is where the next piece of this conversation comes in with what is the massive drop. We have to put context around that, right?
For sure.
So because of the pandemic, the home prices shot up 20, 25, 30%, like we've never seen home appreciation in this country before, ever.
Right.
The correction is just it's gonna erase that gap. That's all it's gonna do. Let me give you context. Context here is this: the average home price before the pandemic hit was $327,000.
Yeah.
Then in 2021, it went up to $380,000. Then in 2022, it went up to $407,000. Okay, so that's a huge, massive, massive number. Now, I believe we're going to see a 10% correction. Context matters. That means that the home that's worth $407 now, maybe this time next year is worth $375. Here's the context. That home is what it was worth in 2021, and it's worth more than it was worth pre-pandemic, which suggests normal home appreciation, pretending that the pandemic never happened. That these homes in the last 2 years would be worth $375 from $327, not $400. I believe that's where we're going to settle in. And that interest rates settle in at 4.5%. It's more of a neutral market. It's not a buyer's market. It's not a seller's market. It's a neutral market, meaning inventory levels match that of demand, that the buyers and sellers are equal.
Right.
And so that's, I think, what will happen to prices. Now, let's go back to your conversation about demand. So when we look at demand, we say, okay, what is the average days on market? How fast are homes selling based on that demand? Okay, context. Right now, we're sitting at 26 days on average. Sometimes homes sell in days, and sometimes they take months. Giving context, 2021, this time last year, when we had the hottest real estate market of all time, it was 17.
Right.
So it's 9 days more on the market. Give you more context, it was 32 pre-pandemic. Right? So even if we retract the time now, even with interest rates at 7%, homes are still selling faster than they were before, to your point, which means people are still buying. Demand is still strong. And so it's not this huge dip, to your point, which is great. And then the other thing is that you brought up is list to sold price ratio.
Right.
Meaning if a homeowner lists their house at $100,000, how much are they getting on average?
Right.
Right now they're getting $100,000 on average, which is phenomenal.
Right.
Meaning seller wants this, seller's getting it. With interest rates at 7%. Last year they were getting more than that. On average, homes were selling for 102%.
Right.
Pre-pandemic was 98%. So when we talk about the market retracting or correcting itself, when we hit this new baseline, that baseline, I believe, will still be better than we were at 2 years ago. And by the way, the market 2 years ago, nobody was bitching. It was phenomenal. Great real estate. It's going to be better at baseline next year than even that.
My thought, so the reason the argument again, and it can go either way.
Don't get sad. It's all right.
No, it's okay. So, but my thing is that, so if you're talking about you're talking like $27,000 decrease in, like, you're going to save, right? You're going to save $27,000 on your purchase price after what, 6-8 months, whatever it might be.
Potentially.
Problem is
Not
that
absolute.
when if you're
Don't
waiting,
put absolutes on me.
whatever it is. So if rates go down, right? So and you're going to say, okay, well, I want the property to be $27,000 less, and then rates will go down to 4.5%, and then I'll buy that house, right?
Okay.
So that change in purchase price, that $27,000, to put it into a monthly payment perspective, is $125 a month.
Okay.
Right?
Yep.
The difference in that rate change from 6.5 to 4.5 is 2% on, let's just say $350,000. That's $7,000 a year, $350, or $7,000 a year is what, $600 a month.
Okay.
Right? So the thing with waiting, you're not the dollar, because when the rates get down that low, that demand is going to come back up.
Yep.
So that value, that correction that we had is going to get soaked up with this demand for people that have been waiting to buy homes.
That's a good point.
At lower rates. If you can buy, like, I think for negotiating price, and people that have their house listed right now, knowing everything they know about the market, we're heading into the best time to get a great price on a home. As these rates crest and start to come down, people are going to start entering that market, and it's going to become more competitive. And there's enough control for foreclosures and enough control for things that there's not going to be a massive influx of inventory. So still having that smaller inventory, days on market are still very low.
Yeah.
And then all of a sudden now you've got all these people that are like, oh, rates are low again. I better strike now. You think that all these people that didn't get their offers accepted the last 2 years because you had to have a $150,000 appraisal guarantee, you had to give them a cat at closing, you do all this stuff.
Yeah.
All those people that are missed out are pissed off. Now rates are up. They're like, I'm not buying now. And what do you think they're going to do when rates go to 4.5%? They are going to come out swinging
because they have context. They have something to compare it to. It's huge.
So
it's a massive point.
I think
look at you.
If you go back, so now look, if you buy a house now, say maybe you pay 5% more than they'll be worth in 6 months. Sure. But if rates come down 3%, now you've got you ended up in a better place in the purchase. I don't know.
That's a great point.
If you can afford the payment today and you have a need to move and you can get a price in an area that you like and it works for your family, buy a house because the opportunity to refinance will come back.
That's true.
But the problem is when that opportunity to refinance comes back, so is the demand for all these people that are pissed off they didn't get their house because they didn't have the money for it.
Yeah, and I agree 100%.
Yeah.
Spot on.
Thanks.
It was a really good point.
I was almost sweating.
Yeah, I had you sweating with that
just
debate?
a little bit. No, I just
right.
was getting all jacked up.
So the next thing to your point though is inventory. I mean that is this thing, right? So it's mortgage interest rates and inventory, the supply and demand, right? Well, last month 589,000 new homes came into the marketplace. Now let me give you and the audience some context of what that means, right? Without comparison, you don't know. Last year, this time, it was 729,000 new listings came into the market. Pre-pandemic was 725,000. A lot less homes are hitting the market right now, probably because what you said earlier, because these people are just, again, trying to wait it out. And so the other argument is that if rates start to crest and then more sellers get off the sideline, they start to list their home. Now you have more to choose from, right? So it just equals things out, I think.
And that 589,000 number, there's a kind of a funny background to that too, is how many of those homes are completed? Because how many listings do you see that you're like, this house is sick. Yeah. I'm gonna go to be built. Damn, come on. Then you know the price that it's even listed at is probably 30. I know this because of the situation I'm currently in, that listing price is probably like 30% less than what you're actually going to pay for that house.
Yeah.
You know what I mean? So it's the completion numbers are kind of interesting when you start to look at that, because there's so many builders just have land and they list it as a complete, like it seems like it's a completed home and it's not.
Yeah. Well, and so now talking about the driver of home prices specifically, we talked about demand and mortgage interest rates. So now let's further unpack inventory, right? So this is why people may want to wait, and you don't agree with that maybe, but what they're looking at is the data. The data suggests that inventory is up 14%, meaning there's over 1 million homes for sale right now, where we haven't seen that for a while. Last year we had under 1 million. In 2020 we had under 1 million. You had to go back to 2019 to get over 1 million homes for sale.
Yeah.
And so if that number continues to creep up, it will drive the price of homes down.
Right.
And so this is what we're going to have to look at next month as we get into the October numbers. That's the number we have to pay attention to in addition to mortgage interest rates.
I agree with that 100%. The other thing to concentrate on or look at with that number is, number one, that includes homes under contract. So that you could have, usually in the last few months, about 40% of the active inventory is under contract, which is kind of interesting.
Right.
And we're coming off of the highest inventory months of the year. So this is normally the peak of inventory.
Yeah.
So again, and it all plays into the numbers, and it's still, like I said, buyers are paying more. Like if you go out and you buy a nice suit coat, right? Like you are going to be much more picky about your fabric.
You're suggesting
you're
this is a nice suit coat?
I love that. It's a beautiful coat. But you're going to be much more picky about your little buttons and all that kind of thing if you're paying a lot of money for something, if you're paying at the top of the market. Yeah. So buyers are getting more picky, and we're seeing that now. There's no doubt. Big time more picky. Yeah. So that's something. The inventory will help with that, but I think that as the months we're on, I don't think that especially if you back out homes under contract and completed homes, it'll be a really interesting number if you can back all that out and see what's actually out there.
Yeah. So we'll see what happens. I mean, obviously we have the Fed's meeting in
November
2nd and December. And so everyone is under the belief that they're going to raise another 3/4 in November. And then,
people are pissed.
Oh, they're pissed.
Not us.
No, right.
So if you look at one thing, and this will be my last rant, but something really interesting like that's happening outside of the United States, and it's great that we're insulated from it, is as the Federal Reserve starts to raise rates, the dollar becomes more and more valuable. And something you have to think about is that a lot of Europe has really focused on renewable energy resources and these types of things. Well, so what they did was essentially they became very reliant on foreign oil and foreign gas. So what happens is now they're cut off because of the war in Russia. And so they're now purchasing barrels of oil from the same sources the United States and things like that are. Well, oil is all traded in dollars, right? So in order to buy, if you live in Germany, you have to take your, I don't know what a German, I don't know what a German money is.
I don't either.
You got to take your German dollar.
Yeah.
And you have to convert that into American dollars. Well, if a German dollar is now worth, you get one German dollar gets you 80 cents American. Well, think now you're at a 20% increase on already record oil prices.
Yeah.
And that trickles all the way down to like a lot smaller countries have to convert their currency, which is much weaker than the dollar, because as we raise our interest rates, the dollar becomes more and more valuable. So that's why you've seen one thing that it actually, there's some articles that said, for the first time in 6 weeks, 30-year rates have come down. And that's because the UN actually came out and said to the Federal Reserve, like, you guys have to slow down on raising rates because the dollar is so strong in all these other countries that they're literally like, we're taking like this massive global recession is looming because we're continuing to fight our inflation at such a high level. It's kind of crazy.
Yeah.
There is a whole, I won't get all the numbers right and you guys can do this. It's called interest rate risk, but there's a lot of like in Europe with purchasing bonds and things like that, because buying American bonds with euros, right? So a euro, you would get $1 in American, or 1 euro was $1.21 in American. So you could take your euros and buy mortgage or U.S. debt, right? U.S. bonds, and you're going to get, $1. You get $1. 1 euro gets you $1.21 to invest in the United States bond market. Well, now that is your $1.21 is now worth like 96 cents.
It's inverted.
So so when you get your money back, you're actually losing all these investments these foreign countries have made in American bonds. They're all losing money because our currency is so much more powerful now.
Yeah.
So it's really, it's going to be an interesting couple months to see what happens globally with oil supply and OPEC just turning it down 2 million barrels a day. I mean, we're going to see when the Fed said there's going to be some pain, like in America, we have it pretty damn good compared to what some of the rest of the world's going to see.
It's a great point. And it's going to, the other big driving factor that I'm looking forward to is what happens in November with the elections.
Yeah.
I mean, that's one variable that will, I believe, have a huge impact on what happens for the remainder of 2022. You agree with that?
100%.
Yeah. Do you have any thoughts on who is having a housing market crash is China? Do you have a thought on that?
No, I don't pay any attention to it. I couldn't speak on it.
You don't write mortgages in China anymore?
No, I quit that.
Okay.
But I've had to document mortgages for people that had a mortgage in China,
Sure.
which I'm like, why did you disclose that?
Right.
I mean, we always do the right thing, but I'm like that. It is so, you make one payment a year.
It's crazy.
You save up all your money all year and you make one lump sum payment.
That market's collapsing.
Yeah. China, I mean, all of that, again, all these global economies right now are all feeling this.
Yeah.
And I mean, China, you have to think they have the zero COVID policy there. They literally shut that country down with a couple cases of COVID where in the United States, we're like, you don't even have to wear a mask anymore.
Right.
You know? Or if you think about Formula One in Japan. So
Yeah,
I was watching
I know.
F1 today.
Yeah.
Everybody wears a mask.
I
There's
know.
still like it is much
Lockdown.
It impacts them much more, but the populations are just so dense there that it's easy for that stuff to spiral out of control.
Yeah. So, all right, last question for the show. Is Max Verstappen going to win the championship at the Japanese Grand Prix this weekend?
It's not possible.
Why?
They said that this morning.
In the pre-show?
Yeah, he wouldn't be able to win it until he was in Austin.
Because
there's no point combination where he could leave more than like 113 points ahead. He could be like tied for it, but he couldn't guarantee the win of it.
So the question then is, when are we leaving to go to Austin?
Well, it's going to take us 3 days to get there based on how much water and coffee we drink. So.
Yeah. So listen, thank you, dude.
Get that dialed
This is your official September 2022 housing market update. If you guys have questions for Steve and I, just put them in the comments beneath this video, and then Steve and I will circle back in the next couple of days, answer those questions. We'll see you guys back here in a month's time. Thanks for watching.
Thanks.